Good morning, all. I hope you are well, and I hope you had a great weekend. So, I have three pairs on watch today, and those are dollar yen, Aussie Kiwi, and pound CAD. So, I'm going to start off with my favorite of the bunch, which is dollar yen. And I'm going to start off on the daily chart. I'm not going to start off on the weekly chart on these videos. I'm going to just take you through the daily chart downwards at the moment. Not that I haven't done proper top-down analysis, but sometimes it's difficult to get everything that I need to say into a 20-minute video, given that that is the maximum that TradingView allows me to record for in these videos. So on the daily chart, on dollar yen, you can see we have this. If we just zoom left, this is an all-time high, at least according to my data. So this is an area where the bigger players, the buyers, would likely be getting out of their positions and the sellers getting in for a move to the downside. Okay, so you can see, what do we know about these significant highs, particularly all-time highs? We know that, typically speaking, price breaks above if we're going to move to the downside for the longer term moves rather than just tapping into it. Okay, what do we see here? Price comes up to test here. Price comes up to test this high. Okay, it doesn't break above, which is atypical for such a significant high as this, and it's no surprise to me that we move down in a manner which has these sharp pullbacks, okay, and which doesn't go on for a particularly long-term move. We then move to the upside. So these sharp pullbacks in themselves are an indication that there is still liquidity up here and orders being placed in the area, which is dragging price back up whilst people are simultaneously trying to sell this. Okay, so the clue is in the price action. We who trade the Falcon strategy are not just looking at what price is doing, we're looking at how price is doing it. So if price is not moving down by way of tight corrections like that from the top, which is usually the banks and the bigger players stacking their orders for the next wave to the downside. If we're seeing these sharp pullbacks, that is an indication that we're going to come back up in itself. And that's exactly what happens. We also typically see these near misses. Okay, so we have this kind of structure here where we have a 1, 2, 3. Okay, this is what I like to call the FOMO channel. Normally that looks a little bit more like that. Okay, but we see a bit of momentum coming here. But when we have a near miss, for the same reasons previously expressed with this high, okay, that is an indication within itself that we're going to come back up. And then we typically see the three drives: the first drive, second drive, and the third drive. Okay, but once again, we tap into the area here and we don't break above it, giving me a clue that we'll likely come back up to take out the high, catch people the wrong side of the market as well. Okay, so up here is a bargain area of value for a sell for the bigger players, and what we typically see is people getting themselves caught the wrong side of the market once price breaks above, because they start believing, for one, that resistance becomes support once it's broken above. And the clue for me here is that, and I was anticipating this well in advance prior to last week, I thought that we'd likely break below all of this consolidation, wick below, wick back up, and then come back out to take these highs, take these highs out, and that's exactly what's happened as well. Okay, and the clue for me is, as I've said, you can, when you get these solid bodied green candles, okay, that's often a clue that we're going to move higher, but those can often retrace. When we see these very bullish green candles like this with a big wick below them, that is even more so a clue that we're going to take out the highs, because this implies that liquidity was grabbed from this area, which is exactly what I was anticipating for a move to the upside. Okay, you can see here we are well in a run of momentum to the upside, and it looks likely that we're going to take out these highs once again. What do we have here? We have a near miss here to this previous high, suggesting once again that we're going to take out that high, which appears to be what's happening at this moment in time. We're getting exhaustive price action, which also suggests that price is running out of steam and that we will likely reverse in this area at this moment in time. So what I'll be looking for, quite simply, this is very, very simple trade. There's nothing particularly complicated to it. This is about as textbook as it gets. So what I'll be looking for is price to tap into this area of value, okay, the high that we've near missed to here. And then I'll be looking for a impulse down on the 1 hour chart, as I say here in my bullet points, a 1 hour impulse down below the area of interest, so the previous high. And the reason we want that is because we don't want to end up in a situation where we break above that. I mean, they're so close that we would, if we broke back below here, we would likely break back below here as well. But the reason I specify a break below my area of interest usually is so that we're not retesting that area of interest, okay, and then we end up being tagged in and tagged out like that. So a break back below the area of interest, and then either as a minimum of 5-minute continuation, so 6 to 8 corrective 5-minute candles, and then I would look to get short on the break. If it was a 15-minute continuation, then I would do the same thing, but I'd also simultaneously be looking for the risk entry within the flag, okay, and then I would be able to manage it down to this sharp move here, this sharp point here, which retested the back end of this previous consolidation, okay, and kind of retested that as well. So that would be my first target for something in the region of 4%, okay, and then I would use I would also be using the mechanical management tool. So someone's just private messaged me. I don't know who that was. I would measure it from here to here, and I would set a take profit there because the 90% area of a range is typically where price can pull back some distance, even if it does continue in your forecasted direction. So I would set a take profit there while simultaneously trailing my stop loss, and then that would give me something in the region of 9.5%. So that is dollar yen. I'm going to move on to Aussie Kiwi. I've noticed that on TradingView, as soon as people see the little green light on your name and they see that you're online, they try and private message you and sell you stuff and all kinds of stuff, but that's another matter. So if on the daily chart, you can see here, we have tapped into a significant area of value. This is slightly lower down on the list because we have a near miss to this high and then a near miss to this high, okay? And this overall correction is very wide relative to that move down. So there's always a chance that we could take out these highs, okay? So if I'm looking to get short, that just ever so slightly increases the risk, but we can't deny that this is a very significant high. And the important thing is how have we reached that area. Look at this price action. This is exhaustive price action, okay? This is not typical. Sometimes these can be running channels to push higher, but this moving up like this is not typical for something that's just going to break to the upside like that. I can't remember the last time I saw that. So that gives me a clue that we're likely just tapping into this area. It gives me a clue that we're likely just filling this green wick, okay? These green wicks often get filled, not so much when we've already broken above, but sometimes they do. But this is a real simple trade, okay? Area of value, exhaustive price action up to that area of value, and then I'm looking for a move from here all the way to the start of this correction. And the reason I'm not you might be thinking, well, why wouldn't you be targeting there? Well, if you look at, because of those near misses, okay, what this could be is we get a move down to there, maybe we get a sharp pullback, which results in the near miss and the FOMO channel. Then we tap into the start of the correction. Then we push higher, okay, to take out all of these near misses, all of these highs which near missed to a previous high, and then that would make sense because if we then measured the impulse and we assume that the continuation leg out of an impulse correction continuation is of a similar length, that would take us up to that high there, which was the start of all these near misses. Okay, where all these near misses keep near missing too. Okay, so with that in mind, what I'll be looking, we may be able to target if these near misses weren't here, then I'd be more likely to be targeting, depending on what it looked like, all the way down here. That would be my, where I would anticipate price moving towards. But if we just zoom in a little bit, you can see that that is where the correction started, where this corrective move started. However, we can actually see that we have, if I just get the forecast on the chart ever so quickly, we do have a near miss to this low here. Okay, so already that is giving me an indication. This, I've just changed my forecast because this near miss wasn't here when I did the forecast last night. So that is giving me a clue as well that this could be a bull flag where we end up coming back down. We take out the low that we near missed to, and then we push up from there. So when that's the case, and that wouldn't be ready by the end of the day, okay, because it would need enough depth, okay. So when that's the case, when I'm looking to get short, and I'm looking to get short below something which could be a bull flag to push higher, I always look for a 3-touch flag as opposed to a 2-touch one to confirm that the flag that I'm looking to get short on the break of or within is not part of the bull flag. If I'm looking to get short, is not part of a bull flag to push higher. Okay, that would confirm that it's a separate structure. So with that in mind, what I'll be looking for is I'll be looking for a break below here. And I also, just to touch on it, I don't look for 5-minute flags when I'm trying to ensure that something isn't part of that a bear flag isn't part of a bull flag. Okay, I also don't wait for 5-minute flags. I look for a little bit more deliberacy by way of a 15-minute continuation. Okay, so with all of that in mind, what I'll be looking for, it doesn't look likely at the moment, it has to be said, but I'll be looking for a break below this area of interest, followed by a 3-touch 15-minute continuation, and then I would I don't know why that says there's an 3-touch 50. There's an error on my forecast, so I'm going to actually amend that in a minute, but I will be looking for a reduced risk entry on the break of this 15-minute continuation or risk entry within it, and then I would be able to manage this. I would set a take profit literally at the start here, and I would manage my stop loss accordingly. Okay, so just a short-term move, and I have an alert set there just to see if we can break below that area of interest. And if we did, you can imagine what that would look like on the 4-hour chart. There would be heavy momentum by that point, and also we would be we would be trading below this previous daily candle, which came up to fill that previous bullish candle. The daily would look very, very bearish by that point as well. Okay, so that's what I'm going to be looking for. As I say, I don't think that's likely to be ready by the end of the day, but we might also be coming back up to test this high before the drop off. So we should just see what happens. Okay, so that is Aussie Kiwi. I've color coded these just to make it easier in the moment to see. So these are lower risk positions. Okay, this would be an example of a lower risk position. If we just zoom out, okay, the next high after this high is so far away that I'm not really concerned. You know, this is not the sort of trade where, you know, if this high was closer, I would deem this to be a higher risk position, but it's so far away that I'm just trying to separate all this mess because by waiting for a 3-touch flag, because before you know it, you end up getting tagged in and tagged out, and then this just keeps trickling and trickling. So when we have these kind of long corrective price action, this is where a lot of losses are taken. So the 3-touch flag just gives me a little bit more deliberacy. But these are the lower risk positions, and this is the higher risk position, pound CAD. But I wouldn't take that until my rules are I have to be in profit by 2% for a month to take a higher risk position. And since none of my entries have shaped up yet, one of these positions would have to put me in profit by 2% for me to be able to take this next position. So this is just on the radar just in case that happens, because we never know in trading. So on the higher time frames, you can see we've kind of, if we just touch on this, so we have, if I can get TradingView to do what it's supposed to do, right, there we go. So we have a near miss. We have a near miss here to this previous high, which I think we will likely gravitate back towards, because when there was an exchange of liquidity here, look how aggressive it was. That is often a clue that there was a big exchange of liquidity when you get a sell-off like that, okay? And the other clue is that we near missed to it, okay? FOMO channel, we near missed to it again. Another FOMO channel, okay, to some extent. Doesn't mean to say you can't make money in there. So how I'm seeing this at the moment is what I'm looking for is I'm looking for a tap into this area of value, which would likely retest the back end of all of this volume, for a move down to this low, which you can see there, which this low near missed to, and then potentially a reversal from there, which would complete this structure to give us this 1, 2, 3, where this is the middle section. Okay, so we would have this middle section there, and then this impulse, and this impulse would be of a similar length, and then potentially that's where we would see the reversals to potentially take out this low, which this low kind of near miss to some extent. Okay, so that's the thesis. Okay, you can see that we are kind of stalling in that area of value as well. So as I drill down, you can see low momentum candles at the area of value. So yeah, just looking for a break above here. We would likely retest the back end of that and then take out this low, which this low near missed to. Quite a simple one. Nothing really to report on this one. And the reason this is slightly higher risk, though, is because, so I'll be looking for, in this instance, a break above the area of value, not a tap into it, specifically a break above. And the reason for that, just to touch on it before I forget, the reason for that is if we just look at the weekly, okay, look at that weekly close. I said to you that if we just have a solid bodied green candle, these often retrace, okay? But when we have a solid bodied candle like that with a massive wick below it like that, in my experience, when price taps an area of value, it usually breaks above before moving to the downside because of how much liquidity was grabbed down here, okay, where the wick was formed, okay? So because of that, I'm specifically not just waiting for a tap into, I'm waiting for a break above and a break back in, okay, to confirm that all of the liquidity has actually been washed out and I don't end up, for example, getting, you take a flag like that, which is literally just tap the area, you get tagged in, tagged out, then it breaks above because of the momentum of that last weekly candle, and then it moves to the downside, okay, and then you end up being liquidity for the bigger players to some extent. So I'll be waiting specifically for a break above, not a tap into, a 1 hour impulse down below the area of value, and then either a 2-touch 5-minute continuation, a reduced risk entry on the break, or a 2-touch 15-minute continuation with a 5-minute risk entry within it, or a reduced risk entry on the break. And the reason this is higher risk, because even then you could be tagged in, tagged out, price then takes off, takes out that high, and then we end up with, so the question I ask myself is, if price was to take me out, why would it do so? Well, it would do so because of these near misses up here. Okay, what would it look like? Well, it would look like that. And then the next question I ask myself is, does that look abnormal? And the answer is no. So if it doesn't look abnormal, then that's how I deem these entries to be higher risk. Okay, where with the other two entries, if price was to take me out on the other two entries, I'm not going to go through that now, but it would look abnormal. So therefore, they're lower risk positions. That's how I, mechanically quantify what's lower risk and higher risk. And then in this instance, I'll be able to manage it down to this low here, where there was volume accumulated. Not too bothered about that low there. You could include that, but even then, you'd be running at 2%, 4%, and then I would set a take profit down here. Okay, and I would trail my stop loss accordingly as well. So that is my forecast for today, folks. It's not what I'm not trying to predict what the market is doing. I'm saying if the market does X, Y, or Z, this is what I'm going to be doing. Okay, big difference. The amateurs, of which there are many on TradingView and all over the internet, especially on Instagram, the amateurs are trying to be right. The professionals are adjusting their sales when the wind changes direction and trying to manage risk. A big difference. Okay, so we need to be trading like the professionals, not like the egomaniacs that you see on Instagram, but that's another conversation for another day. Thanks for watching, folks. I hope you've taken some value from this, and I'll see you again in the next video.